Welcome to Unsuitable on Ray Radio, the award-winning financial services and business advisory podcast that challenges your old-school business practices and the traditional business suit culture. Our guests are industry professionals and experts who will challenge you to think beyond the suit and tie while offering you meaningful modern solutions to help you enhance your company's growth. I'm your host, Dave Kane.
We're enjoying the calm before the store here at Ray & Associates. In just about a month, it will be all hands on deck for accountants everywhere. And while most of us are still buzzing about federal tax bills, midterm elections, and future tax planning strategies under the Tax Cuts and Jobs Act, our state and local tax team is looking at this upcoming tax season from another angle. Joining us on today's episode of Unsuitable is Luke Lucas from Independence, Ohio. Ray's office is located in that location. He oversees income and franchise tax manager for the firm on Ray's state and local tax team. Luke is here to help us understand how our state taxes could be impacted this year by federal tax reform, by the Wayfair v. South Dakota decision, and the recent commercial activity tax sales sourcing rules. Welcome to Unsuitable, Luke.
Thanks, Dave. I'm glad to be here.
Thanks for making the trip down 71.
Definitely. Just
from Browns country.
Short 2-hour drive.
Yep. Now, how many games the Browns going to win this year?
Not looking too good.
Not looking too good. Great. So, great for a number one draft pick.
True.
That's what we're after. So, hey, a lot going on the tax side. A lot of times on Unsuitable, we're talking about federal tax reform, and of course, we've had several different episodes on the Wayfair case, and that's impacting a lot of companies that we deal with. So, let's start talking about state tax impact. That's I guess kind of morphed from the federal tax reform.
Yeah, so obviously, most of our listeners have heard plenty of, about federal tax reform. What people might not think of right away is that there's a trickle down effect to state taxes, especially state income taxes. So now it's been about a year since federal tax reform has been in place. All of the states have had time to have their legislative sessions react to the federal tax reform, and now we're finally starting to get some clarification on what it's going to look like going forward.
So we're right. The calm is before the storm.
Right.
Once the states figure out how to attack this.
Right.
Now, I understand that you were at the session in Washington, D.C., the Supreme Court. For the Wayfair case.
That's correct. Joe wrangled our department up. We went down there, I think it was Friday, whatever night it was. But anyways,
they all run together when you're in Washington, D.C., huh?
We got down there one night. We woke up at 3 a.m. the next morning and got in line at 4:30 and waited in line outside in the cold till 9 a.m. And then we got to see the hearing. So it was a pretty awesome experience.
So pretty crazy.
Right.
Yeah.
Definitely.
So anyway, let's go back again. We talk a lot on the podcast about business risk and trying to mitigate risk. Is this state issue, if it goes undetected or you don't have a plan, is that going to increase the risk within my business?
Oh, definitely. We'll see a lot of times, we'll have clients, they might hire a contractor in another state. They might have employees traveling there to another state for business purposes, and they really don't recognize the risk that they're exposing themselves to. And with the Wayfair case, it just gives the states another option to look at them and get them.
So it's coming 2019, 2020. What are you thinking here? Where's it going to hit the fan?
Well, for the Wayfair stuff, the states are all responding on the sales tax piece. It's important to remember that Wayfair is a sales tax case. But historically, states have derived their income tax laws around another sales tax case, landmark U.S. Supreme Court sales tax case, and that was Quill Corp versus North Dakota. Basically, that was in 1992, before the internet was born. I wasn't born much before that.
Way to rub it in.
But anyways, back then they said if you can only impose your taxes on a business who has a physical location in the state. With Wayfair, the Supreme Court said, the world has changed a lot since 1992. We have the internet, all the e-commerce software. It's really easy to do business across the United States and even the world.
Right.
So, what they said is you no longer need a physical presence to impose a sales tax on an out-of-state business. Now, where income tax comes into play is, like I said, states have historically derived their income tax nexus laws around these sales tax Supreme Court cases.
Okay. Well, let's go back and kind of redefine physical presence. You and I kind of talked this off mic, but the old traditional physical presence mean I had a storefront, I had a warehouse, I had employees, I maybe had some inventory within a state. That was supposedly the physical presence test.
Right.
But now they're testing more than that. Explain that to me.
Yeah. So traditionally for physical presence, like you said, you got the employees living in a state, or your brick and mortar business in the state on Main Street, maybe some inventory in a warehouse in another state. But now people are traveling all across the country for business work. So just traveling to another state can create what they call physical presence.
Okay.
And really most of the time, if you're there a day or two, that's enough to exceed their threshold and allow them to impose their tax on you.
So so that we're talking about. Are we talking about just sales tax, or does that sprinkle over into income tax?
That is for both sales and income taxes.
Okay, so again, this nexus or physical presence, all these tests, we're testing two things: sales tax and income tax, and maybe other state taxes that are in existence.
That's correct.
So are there any states I should stay out of? I'm going off the grid. Where should I go?
Well, I wouldn't go to California or Washington. They
Okay.
are seem to be two of the more aggressive states out there.
Yeah. So stay out of there, or now again, there's a good message there. If we're located in Ohio, and we have some activities, some sales or other activities out in California or Washington, we better take a look at that.
Right. It's kind of ironic that I brought those two states up, because those are two of the states that have this income tax nexus bright line threshold, and that goes back to Wayfair, where they said, the Wayfair case, if you have X amount of sales, sourced to this state, then they can impose their taxing jurisdiction on you, even if you never step foot into the state.
I mean, another state that's we need to keep an eye on. We need to keep an eye on all of them, but what are some of the more aggressive states? New York?
New York's one. They also have the bright line threshold, which is kind of justified by Wayfair. Ohio actually has it as well, but the majority of our listeners, we're already in Ohio and had the physical presence in Ohio, so we don't really see that affecting us.
Define bright line. There's a couple different definitions out there. Clear that up for us. What's that mean?
Sure. So, when you're looking for nexus, really on a permanent basis, you're looking at apportionment. Not to get too far into detail, but you use apportionment factors to prepare and accurately divvy up income between states and pay taxes in those states. So you normally look at three of the factors. You can either look at the sales factor, the property factor, or the payroll factor within those states. The bright line really comes into play with the sales factor, which is what once again what the Wayfair case said is allowed to happen. And actually, Ohio was the first state to bring in this bright line factor for income taxes. Well, actually, gross receipts taxes, and that's with the CAT tax, which we're all familiar with.
Yeah, I'm glad you got technical there for a minute, because that just proves how difficult this is. It's very difficult to do that without the technology and the understanding of not just Ohio rules, but you guys. I don't know how you do it. You have to track every state.
Yeah, and we run into an issue sometimes with some of our less sophisticated clients with maybe older software. They might get an audit notice from California or Pennsylvania for 8 or so years ago, and they just don't have the software to be able to track their sales by state. So it makes the audit process really difficult when that happens.
So I know in the name of confidentiality, we need to talk at a high level of some of the cases we've run across, but I've heard some staggering numbers of some audit findings for, I would call them medium range clients. They're not large clients, but when the state comes in, they come in for multiple years.
Right. Yeah. Something we always tell our clients whenever we're talking to them. There is no statute of limitations for failure to file a tax return when you're supposed to.
Say that again now.
No statute of limitations for failing to file a tax return when you should have. So, in simpler terms, that means, a state can go back as far as they would like if you did not, meet your obligations.
In other words, grab your ankles if they catch you.
Right. And, what'll happen is, if we figure out that, a client should have been filing in a state, there's options that we can take to help them and not worry about those, 8 or so years ago, but they have to be willing to do it.
So, worst case scenario, you could be on the hook multiple years, plus interest, plus penalty.
That's correct.
Okay. Walk me through a scenario. Let's say you and I are having a discussion, and at the end of the discussion, I tell you, oh, gee, I've got to file in Tennessee, or I forgot to file in California. I want to come clean on this. What do I do?
Sure. So what we'll do in that scenario, if the client would like to come clean, and the states encourage this, we can enter into our client with a state what's called a voluntary disclosure agreement with a state. So basically, we will reach out to the state on an anonymous basis, explain the facts, and the state will review that application, and they'll let us know whether or not they are allowed to enter into the voluntary disclosure agreement. And the benefit of that voluntary disclosure agreement is the state will limit a look-back period. So normally they'll let you go back 3 or 4 years of back tax filings.
Okay.
Where, say, if you owed 8 years, if you should have been found there for 8 years, that cuts off 4 or 5 years of tax filings that you now don't have to do or don't have to worry about being caught. And additionally, they will do you a favor of waiving any penalties for those past filings.
So that's a good thing.
Great
little
thing.
amnesty, mini amnesty.
Right.
So I suppose if I say, hey, look, I don't have records past, 5 years. My insurance company told me that I didn't need to keep records that far. Is that a legitimate defense?
It is not. The states can, really, if you can't, prove beyond the benefit of the doubt that your sales aren't sourced to X state, I mean, there's really not much you can do. That's why if you're in that situation and you can't produce the records back that far, it's really good to enter into a VDA.
Hey, Luke, I don't have a problem here. I certainly didn't pay tax in California. I paid it in Ohio, so no problem. I'll just file California and get a refund from the state of Ohio for that sales tax. Am I on the right track, or
Doesn't
SOL?
doesn't quite work that way. I mean,
Thanks.
It can, but
I'm out of money, aren't I?
Yeah.
Plus fees.
Yep. Plus compliance fees. Yeah.
So plus on their radar, most likely for years to come.
Right.
So, and as the cases that you've run across, and we try to get a feel for this from other guests on our show, from your state and local tax team, your SALT team, but when you go out and you look at, let's say you look at 10 different cases or 10 of our clients, how many of those are you finding that there are deficiencies in state tax filings?
I would say a very large majority of our clients.
Give me a number. Go for it. It can't be tracked.
I'll throw out 90%.
90%.
Yeah, 90%.
Okay. That seems pretty consistent.
Whether it's income or sales tax,
Yeah.
chances are they have something that they should have been doing and just don't know about it.
Yeah. Now, a bit of clarification as we go through this process. I don't think that it's not a double taxation. It's just that, hey, if we had to pay tax in Illinois or Indiana or California, that means we shouldn't have been paying it in Ohio.
Right. Yeah. There's really not a double taxation. Like I said, it goes back to that apportionment factor that states make you use. It kind of divvies up your net income across all the states, and then you pay tax, based on those states' rules.
So you'd mentioned apportionment. Is that something that's readily available in my accounting records? What exactly am I looking for? I'm a business owner. I'm on the sales side. I have no idea what apportionment is.
Yeah. So apportionment, like I said, it's a calculation, a formula, and all states they can be different, but most of them, are pretty similar. You look at the property, so you look at your fixed assets or inventory in a state. We would average out the beginning and ending amounts to figure out your property. You look at payroll, so your payroll filings. You look at your payroll filings in that state versus everywhere amount to give you your percentage. Then you look at your sales as well. So your sales sourced to that state divided by your sales everywhere.
So, a couple things I'm taking from our conversation. One is I better make sure my team they're keeping records long enough to support some of these things if an audit does exist, because if not, we're in deep trouble. We're writing the check.
Definitely. And, from my experience, states, clients usually take the position where states sort of take a back seat to federal issues. Back to the federal tax reform, looking at your net income calculations, for federal tax reform,
Right.
they brought in 100% bonus depreciation. They disallowed DPAD. So, there's some stuff that benefits, your taxable income and, is a deferred, liability toward your taxable income. But really for the, corporate purposes, the big savings amount is the reduced tax rate. And that doesn't affect the states.
Right.
So what happened was...
I don't like where you're going with this.
What happened was EY and COST, which is a governmental agency called Council of State Taxation, they did some joint report analyzing all the changes, what they predicted the states were going to do with the changes, and at the end of the day, they determined that the average state tax base is going to increase 12%. So at the end of the day, states are more of an issue than they have been before.
Sure. So I think what you just told me is that my federal taxes are going down. My state taxes most likely are going up.
That's correct.
And as hungry as states are looking for revenue, especially with internet activity, the states are going to look harder and faster.
Yep, and something that I think people don't realize either is that the majority of the states are actually required to maintain a balanced budget, whereas the federal government, is not.
Imagine that, huh?
So, basically...
Isn't that a novelty idea? Balanced budget, how about that?
So what it comes down to is the states are going to look for any way they can to get their income from you.
You'd mentioned CAT, or commercial activity tax. Are there changes going on with that? That's the tax that's the tax that replaced the personal property tax several years ago.
Yeah, so the CAT replaced the
Back when you were in grade school, we used to file personal property tax.
That's correct. The CAT replaced the personal property tax as well as the Ohio corporate franchise tax back in 2005. Obviously the CAT is going to be relevant to a large majority of our clients. And also a byproduct of all of these Wayfair discussions is sales sourcing discussions. That could get quite complex depending on your business type, but back to CAT, there have been a couple developments this year, within the past year, where it kind of takes an advanced look at sales sourcing, and the state have fought with the taxpayers, and there's been a decision. So in one case, I think it was Greenscapes versus Testa. Greenscapes Lawn and Garden, they are a lawn and garden company down in Georgia, actually. So what happened is, they would sometimes have customers pick up the product in Georgia, bring it back to Ohio. So Greenscapes argued that that was a Georgia source sale, and maybe Georgia's laws might say that actually. But what Ohio found out is, they're picking this product up in Georgia, bringing it back to Ohio. Ohio said that's an Ohio-based sale because that's the ultimate destination of the product. So, that was Ohio, ruled that it was an Ohio sale at the end of the day, and, that's not very favorable for the taxpayer. And, in my opinion, it's a situation where maybe, for out-of-state taxpayers, ignorance is bliss. Maybe they don't want to know where that product's going to end up.
Sure. In the example you used, I don't have to pay tax in both states, do I?
Depending on the state's rule, you might have to source that sale to both of those states, unfortunately. Now, you're not necessarily paying tax in both states, but you're sourcing the sale and divvying up the income twice.
Again, got to go back to the accounting records.
Right.
What if my accounting staff doesn't know exactly what kind of records to keep? Can you guys help us out with that?
Yeah, that's something, like I said, depending on their business model, we can have those discussions and, help them be prepared if out-of-state tax tax departments come knocking.
So you can help train.
Definitely.
You can help train audit defense. I get a
Mhm.
letter. Can your team help me out navigate through that?
Yeah, we can. We'll handle everything for the client. With the audit. Work with the auditor. They're generally pleasant to work with, believe it or not. But at the end of the day, whenever the auditors give us their findings, we'll also review their findings and make sure there's no misunderstandings to make sure they're assessing the right amount of tax.
Now, with the states, if we're caught, and eventually, if you're in this business long enough, you're going to get a letter. I don't want to say caught, but you're going to get a letter of inquiry. Will you help me negotiate a settlement?
Yeah, we can do that if it comes down to it. That happens more on the sales tax side. There's a lot of stuff that goes into that, but on the income tax side, there's really not a lot of gray area for a settlement.
Okay. As 2018 comes to close and we start 2019, what are some things that maybe we can do as a business, in my business, to get off on the right foot so we have correct filings for the states?
Yeah, well, as a business, we're always happy to talk. We can, we give our clients, a higher level discussion, kind of give them some rough ideas of where they might have a filing obligation. But we always point out that that's a general rule. There are general rules across all the states, but all the states happen to have their, quirky rules where, you really want to take a look at the code to make sure we're not telling them to file if they don't need to, or, tell them not to file when they should.
And to your point, we may be filing in some states we don't have to, and on the other side, we probably should file in more states.
Right.
The goal here is not to file in 50 states, and every township and municipality that we're in. The goal is let's take a look and get a fair representation and minimize our risk.
Definitely, and we can also work with the client to strategize, where they're going, where they're shipping their product from, where they're shipping it to help, minimize their out-of-state tax exposure.
That's the education process.
Right.
Good. So again, I think we've covered a lot of territory, very, very technical, very complex. You think the Wayfair case is going to raise its ugly head big time in 19, or do we got a year to get our act together?
Well, for sales tax purposes, a lot of the states are moving pretty quickly there, so those rules are already in place. But people do expect, and I agree, that there's going to start to be more income tax bright line thresholds put in place because of that.
Sure. So actually, with the 2018 filings, this is a real good time to get that right and get a springboard for going forward.
Yeah, very busy time for our department. Client calls every day. The clients are interested in this. They want to see how it affects them, and we're happy to help in any way we can.
You're going to be able to take a little time off around the holidays, or are you going to be working on Cat Tax and Nexus and Brightline or whatever else you're working on?
Plan on taking some time off. Actually taking the week after Thanksgiving off for deer season. So,
there you go.
Yeah.
Perfect. Our guest today has been Luke Lucas with Ray & Associates, located in Independence, Ohio, talking about state tax concerns. And if they're not keeping you up at night, they probably should. There's a lot of risk out there. Thanks again for joining us today, Luke.
Appreciate it, Dave.
You certainly given us a lot to think about, and I'm sure listeners will put your advice to good use. That being said, if you have any state and local tax questions, get them in now. Contact us at raycpa.com, and we'll put you in touch with a member of our SALT team, which also is our state and local tax team. Did you enjoy today's episode? Let us know. Like it, comment on it, or share it. And don't forget to check out videos of our podcast on YouTube. Until next time, I'm Dave Kane, encouraging you to loosen up your tie and think outside the box.